Hello, guys. Good morning. Thank you for coming back to a little mentor session. We just got Dan with us today. Andrew and Reach. I'll be recording this for you guys. Andrew did ask that he asked a question about its use cases for spreads and advanced spreads. Kind of where we can apply them, how we structure them. We did run through, I believe it was either last week or the week before, about the basics of debit and credit spreads. Um, those principles will apply to basically all of the structuring for the spreads. All the principles basically the same. There's just really more legs added, and then maybe you'll be different expirations or just different structure on the spread in its whole. But to start, I'm just gonna form all these on Neo, just a good name to do it on. But we did our debit spreads, we did our credit spreads. So basically, we're gonna roll into the next thing would be calendar spreads. One of my favorite styles of spreads, um, really because it's one of the few spreads you can capture, volatility in 1 week or 1 month, um, and have it pay for something on the back end or pay for something on the front end. A lot of different use cases. You could structure it long, structure it short, but for right now, we're gonna start with the long side. So what I like to do typically, as you guys know, I do like to go look at whatever the straddle pricing is, preferably the at the money straddle. So as of right now, for 3 days to expiration on the $41 strike, we got roughly a $2.35 range that Neo could be potentially trading in over the course of the next 3 days. That could be $3.35 up, $3.35 down. We could take these principles and add it into our spread for structure of a calendar spread. How do we do that? Well, first thing we're going to start for a long calendar spread. We're going to go, let's switch this back to calendar over here. We're going to take our implied ranges, right? So we're going to go, let's see, switch this so I can just add them in. So what I like to do is I take the front month. Front month or the front expiration in a long calendar spread is always going to be the short leg. That should be the closest to expiration, or whether if you're 2 weeks out, it should be the closest to whatever expiration is, and your long option should have more time than the short option. Reason being is you essentially want your short option down here. For example, let's say this would be the 44 strike call, um, for March 2021 on the 26th expiration. You know, we essentially want to sell this call to be able to pay for our April 21st call. And we do that for maybe, let's say this week, for some reason, Neo's implied volatility may be higher than normal. And let's say the options tend to be a little more overvalued. Well, maybe we can sell that option, and over the course of the week, maybe we can collect some premium to help pay for that long option. And then if we see another opportunity, maybe we can then add another short leg to roll into the next week. So what I like to do is take the long option. Preferably if you're doing anything short-term swings, the long option should be 30 to 45 days out. Take the implied range. You can add the $2.40. You can call it $3 if you want. So you could take the 44 strike or the 43 strike, one of the two. I'm gonna take the 43 for this example. And in terms for the short option now, how I like to do this, I do like to go stay within 2 standard deviations. So we'll just go double the at the money straddle. So that'll be roughly a $5 range. Gives us a little more chance probability to be in our favor. Will we not take in as much of a credit on the short option? Yes, yeah, that's kind of a given. But that's all right. There's nothing really fucking against that. It's not really going to hurt us at all. I don't know why this one won't let me switch. Custom. There we go. Yeah, so we'll switch this one. So we'll take for the short leg, we'll go, $5 out of the money. It'll be the $46 strike. And then if we switch this to single over here, we'll kind of see that 46 strike roughly be taking in $10 worth of credit or 10-cent credit. And then our April 1st, we'll actually roll this one out a little bit farther. We'll take this May expiration over here because it's roughly 50 days out. All right, so May, scroll down here, we'll take the implied range, roughly 44 strikes, can be roughly, $3 here, taking a 10-cent credit. Now, the power of this, right? I know it looks like we're only taking in $10, and it doesn't look like we're taking shit off the top for the spread in itself, but take into the fact that you don't have to go just 1 week out if you wanted to capture a little bit of more premium. You could always roll in, into the next week. It's going to reduce the, cost a little more, but or you can do the weekly roll in roll out method. You know, you're rolling into the expiration Friday. You'd close your position, and then maybe you'd add, let's say, you go in the next week and it's Friday. If there's a bullish run on a Friday, it'd be a good chance to probably add a short call. You go 2 standard deviations out, hopefully capture a little bit of more premium. You keep rolling in and out, in and out, in and out. And essentially, you want to try to get that long option paid for, but you're really structured still like a debit spread because you're buying one call at a lower strike and you're selling that higher strike. Therefore, as of right now, you're having no collateral restrictions. You're not going to have to fork up any collateral. However, if you turn this short strike down, right? If let's say we wanted to sell the $40 call, well, now we've then made this a short, realistically, we're short more in the front month now. And we're going to have to put up that extra $300 in collateral on the spread because now we're $300 lower, or it actually be roughly $150 in collateral because we have 150 here and would wash the other half of the 300. But in times of if our short leg is lower for the call side, that's always going to be in the case. We're going to have to put up more premium. So we do like to try to stay, for people who don't want to put up collateral, stay with that, the short call being above your long call on the back end. And you're not looking for an explosive move. You're kind of just looking for a little slow climb up, couple good little 1-2% days, little dip down, and having the short leg on there. Generally on a name that probably has more premium, this is probably a better example of for, but you're going to be able to essentially almost like you're running hedged. You could match your theta exposure to cover the theta exposure on the long option. If let's say the stock ripped and then it was pulling back, whatever, going into close, it was pull back for the day. You could add that short leg on there, and maybe you can try to collect some of the premium or some of the time K exposure that's on there. And then another way to help roll it and get it to pay for. If we go to Neo, like the Neo chart, roll to the hourly real quick, right? So in terms of this little sideways action, that's not really where calendar spread, performs all that well unless you have a little bit more time on the short and long edge. Like I said, not something that you'd want to be going into a bounce, like down here when we had, we got a nice little dramatic sell off. When you notice the stock is starting to form, kind of that base flatline support, starting to kind of break the downtrend. Those are really spots where calendar spreads actually do very well because there's a whole lot of mix and volatility that's going on here. You got people buying back puts, you got people buying back stock, you got people adding longs. So there's a whole lot of volatility that really starts to get mixed up, and the Vegas at these part really start to juice up. They end up mean reverting back down, but when this chop session happens, you get a nice little boost up to a gap down, boost back up, gap down. It really messes with the Vega sensitivity. The more that this happens, the more volatility creates in the market, and the better your spread realistically does. Because that short option, if you're short in the front week, you're going to be capturing the most premium. And if your long option has enough time to expiration on it, you really capture that sensitivity that this chop here, because you have time value on the long option, isn't really gonna hurt you as much. If you're getting a $1 to $2 fluctuation, you're only losing a couple of fucking hot dog dollars at that point. So that's something I like to do. And in terms of if you were going into earnings, that this is kind of a strategy that can absolutely work very, very well. Um, if Neo was implying a $5 range for earning, implied volatility is jacked up. So you're going to sell that front month on the 2 standard deviation, and it's going to work out much better in the example like I showed here, because we don't have that massive, Neo can spike up to 200% implied volatility at earnings. We don't have that here on this name, but in times for earnings, we can do that. Same thing with the put side. If we're going to structure this to the put side, same thing. $2.35 implied range, easy. Swap it, move down. We'll take the fucking 38 for the long option, and then we'll sell was 36. Again, no collateral required on this trade. Oh, they must be missing a strike. That's weird why this is. Oh, here we go. There we go. Yeah. Same structure, same idea. You get to capture if you get the short put. You capturing volatility, capturing, you know, any time decay. Generally puts cost a little bit more, and naturally, because when you buy a put, you're buying the right to sell 100 shares of stock at X strike price. So naturally, puts should always be more expensive in that case. So in terms of people running a short put strategy, that's going to be most the case, because naturally you should always have higher implied volatility on the puts. Names that are very speculative, like a Neo, a Tesla, things like that, AMC, GameStop, shit. That's all stuff that has heavy call skew, because that's all impacted by generally retail trading, and people, they're basically fucking high the whole time while they're trading. So they'll push the call skew bid up, and that's usually where you have your premium sellers come in, and they crush that volatility back down. Reach, I just muted you for a second, bro, because I was hearing an echo. Yeah, so in terms of, long, this would be a long put calendar spread. You could call it a diagonal. The only reason why these names really exist, the calendar, would only be because you're crossing in between 2 months. If we rolled into the same month, be structured more like a diagonal. Yeah, really, the reason why this was named, so when Bloomberg designed these fucking terms, you're basically going across the option chain, and then the calendar, you jump in between calendars, and these ones you're usually just going across whatever, like next week expiration or 2 weeks expiration will be within diagonal ranges. Which, let me roll back to single. But yeah, so that would be in a case like this. You buy at 38, sell at 35. It's within the same week across. You're just really going diagonal in the monthly option chain. That's kind of where the names derive. It's still the same structure of the spread, diagonal versus counter. Same structure for the put and the call side and the long and short side. Like I said, the only differences between basically the months and expirations is just a little bit different. All in all, kind of really the same spread. You'd only with calendar spreads too, you're trying to capture, like, if you guys had read what Sean from Predicting Alpha wrote about like capturing term structure skew and whatnot. So like the term structure basically shows, so if we have higher implied volatility, right, in this, let's say, 60 to 200 day range, the term structure is going to show that all implied volatilities be, let's say, slightly higher. So this middle point will be, let's say, take this line, if that's the midpoint for these expirations that have time on it, they may be a little bit higher. But these front expirations, let's say these weeklies, are actually lower. Let's say they're lower in implied volatility. So you're going to see that expiration would be under the higher implied volatility here. So there's opportunity to capture. Let's say if the volatility is elevated in these 5 months, people are going to be selling back end volatility. So they're going to be actually short in the back month, where you'll have to provide some collateral, because if we switch these, right? Okay, so now we're structured exactly like a credit spread now. So now we flipped. So short diagonals and short diagonals, short calendars, they're going to be structured much like a credit spread, versus the long side is always going to be structured in the same terms of a debit spread. So these short calendars or short diagonals, right? You know, if we're putting up on the short side, we're going to take that implied range, and we know the two standard deviations, $5. So we're going to come down and, we'll sell the 35, and then we'll buy. You're going to have to follow the two standard deviations out even for the buy on this, because you're really just looking to wash some collateral cost at that point. So you'd put up, like right here, be roughly $500 collateral cost, and you'd be taking in $1.12 in credit. Pretty normal thing. If you can make 20% of short option position, that's usually a pretty good risk reward. The risk reward is never going to be the same on a short option as it is for a long option, just because when you're buying an option, you essentially have unlimited profit for the call side, because the stock can go up forever. And if you're buying a put, the stock can only go to fucking zero, and that's really your cap. Versus short option, you're only selling what you have. So you got this $112 or whatever. If Neo drops $50, you're still only making 112 bucks. There's no, you're not getting anything extra on it. So keep that in mind. When you're position, you feel like you've captured the idea for your position, take off the trade. And always remember the last 30 cents on an option. If you're selling something for $1, when you get to 25 cents, 30 cents, it's going to be a lot harder to rot the last bit of that. That really won't set in until probably the last, depending on the stock, that could be the very last day. It could be the last hour. On a name like Neo or something, you're going to see like probably the last, 3 days, you're going to see the volatility really start to kick in and start to fall off. But so if we're taking these on the put, like the short put side, this is really kind of a neutrally bullish position. And there's a couple things that you can kind of really do in terms of being on like the short put calendar side, because you're essentially neutrally bearish, right? If Neo ticks down a little bit, yeah, it can move against you. But if it goes nice and slow towards 35 and within your expiration, let's say April 30th, right? You wouldn't go this, generally new traders won't go this far out selling, because you want to experience the buy side before going long in the back or short in the back end. That's really more for the advanced style of traders. Plenty of opportunity to capture, but just something to keep in mind. You are short, you could be assigned at any time. If someone chooses to exercise this put, you'd be put, 100 shares of stock at $35 for Neo. You'd have long stock, which is right. And that's something you could do. If you ever did take assignment, that's all right, because you can take the 100 shares of stock and you still technically own this put. So even if Neo was fucking tanking, you could always close the stock whenever. But if you wanted to hold and let it bounce, you still own that 30 strike put where you can actually exercise the put, and you can sell the stock at 30 if it kept dropping and you didn't feel comfortable placing in a sell order right away. But if you do like Neo and you like picking it up at 35 and it does bounce, that's a win for you. And you have this put more so as just a little bit of protection. You can choose to take it off, but you should gain the $1.12 in credit for the buyer exercising his right to exercise the put. So you gain that $112, and you'd gain 100 shares of long stock. And then let's say, if Neo did tank in the short term, you could close the put, bank on the value of the put. And then, let's say Neo bounced back up, you really essentially you triple banked in that position. You could make 3 ways to profit on that. So there are opportunities in multiple ways to be able to play these realistically. Now, if we're playing this for being short on the call side, I especially don't recommend being short in the back month with calls, especially if you're new, because calls can absolutely just blow, short calls can blow your account out of the water, and take that from fucking experience. Because, like I said, when you buy a call, you got unlimited profit. When you sell a call, you have an unlimited loss potential. Stock can go up forever. That's not a good thing for you. However, you still have plenty of opportunity to, you know, make money doing it, because calls tend to get bid up very easy, especially in names like a Neo, like a Tesla. So we can sell that overbid volatility, but we do have to keep in mind that it's important we stay the 2 standard deviations up, because we want probability on our side, right? And when we're buying the call and we're short in back month, we want to be able to really maximize gaining premium out of the short edge. So if I'm, say, whatever, take that and go to the 50, go to 50 strike. So I'm capturing that $174 in credit now, right? But I'm still, I got roughly a month to expiration, but I still have a $50 Neo call. So if things started to get a little hairy, right? And, let's say Neo teeters, right? And I'll be capturing my premium, but, Neo starts to tick up. Well, I could actually see my long call could start to profit a little bit, which is a good thing. And you could actually sometimes, if not always when a stock goes up, does volatility in the back month go up. Sometimes when a stock rises, the call volatility can actually drop in, let's say, farther out range, because if volatility is priced out, let's say, 150 days out, they're bidding up the volatility a little bit. But all of a sudden, a big move or a nice move happens in the front month. Well, maybe the market makers were pricing that move to happen in roughly 60 to 90 days or 100 days out. So they'll drop the bid pricing for call premiums in the back end, which this is where Sean, who that's something he was trying to do, is trying to sell the overbid back end volatility. And like we know, the Vegas are a lot bigger in the back end. The farther you go out, the Vegas are going to gain value. Are they as sensitive? No. But because they're more value, they that can play a decent weight in the cost of our position. So if in the event, Neo's implied volatility drops 10%, which is very easy for it to do, that's an easy $100 whack right off of, your option. This shit's rotting, 10, roughly $10 every time it drops 1%. That's very good for your short option premium. So kind of two ways to develop. And you're never really going to, if you own 100 shares of stock, like let's say you own 100 shares of Neo, and in the event you did take assignment, you can actually use your 100 shares of Neo to incorporate this in your, for the short leg. Then you just you would sell your 100 shares at whatever the strike price was that you got exercised on, and then you would just take the credit in. That's kind of a way when people are running calendars, that's something that they do. They try to do it in a name that they own the underlying in, because you can essentially roll out of the call position. Because if you own, let's say you own Neo at fucking $30, and let's say you're in this spread, you're kind of neutrally bearish in the back month, but it's essentially like a covered call since you already own the 100 shares of stock. If this strike is hit, bang, okay, good, you've sold your stock at $46 per share, but you still have the back end call there as well. So, like again, 2 to 3 ways to make profit on one position if you have the capital to be able to do that. And you're essentially not outlaying as much risk. If you're outright buying the call, you have full blown exposure versus this is a lot of exposure that's covered. Because if I'm taking this call, right, and I'm selling this one, well, I'm subtracting my fucking Greeks from that long option that I bought. So we're always, these are all risk mitigating strategies for, calendars and diagonals. And it's going to be a way for you to like slingshot yourself each week. And you can get in the habit of rolling in and rolling out. That you're going to see a lot of powerful movements be able to be captured. Now, in terms of, rolling into the next spread, I've kind of already talked about straddles and strangles, buying a call, buying a put on the same strike for straddles. Strangles, it's just off strikes. You could buy the $30 put, buy the 35 call. Strangles can be very powerful in terms of if you're playing earnings and you're not thinking the stock's going to move very much. Selling a strangle on the strikes that probably are the most overvalued on 2 standard deviation can be very high profitable strategy. This is a very common thing for straddles and strangles to be sold for quantitative traders. Reason being because there's a lot of studies done around the straddle. If I buy an at the money straddle when implied volatility is under realized or historical volatility, well, the odds are in my favor a little bit that if I held this long option position over time, just due to that implied volatility being under historical volatility, well, I'm essentially owning something that's undervalued. So, in terms of probability, you would expect that to be profitable, down the line, versus if you bought a straddle that had high implied volatility and it was over the historical vol, you're really buying something that's historically overvalued, and it's going to work against you. So that's kind of where, in terms of the quantitative idea, really came from. It was just more so measuring the volatility and whatnot to apply it into the straddles and strangles. So if they're looking for the stock not to move and fucking pancake at earnings, you're gonna see a lot of strangles get thrown up, a lot of straddles get thrown up. Basically, anytime vol's forecasted to not move much, you're gonna see a lot of these things being added in, and you may see these in. It may look like you'll see a call flow coming in and a put flow coming in, but you can kind of sometimes, depending if you run through like Trade Alert, well, they'll match, they can match the fucking orders, and they'll show you that it's a spread, or they'll show you that it's this. So keep in mind that even though we're paying attention to shit we're seeing on the flow, it can always be rolled into a spread. It could be short, it could be long. It's a good way to take into account for that. So not too much for straddles and strangles. I mean, in terms of when market volatility is really fucking high, like on on the Nasdaq when we had that the fucking drop coming down, and that really would have been a point where running a straddle would have been okay. Really at any point in these, because the volatility fluctuations fuck crazy. You know, you hit stuff, you drop it down. There's aggressive buybacks, aggressive sell-offs. That's in terms of straddles generally do pretty well in that market. More so back in the Corona crash when the swings were a lot bigger. Um, that was really more so. This area was kind of this is straddle heaven, you know, because every move is big, either direction. You're not looking for one direction, you're just looking for it to move a direction. So that's something that's common. So in terms of when earnings coming, if they don't believe that the underlying's gonna move much, they will sell that straddle because that's gonna be the overvalued call, the overvalued put. They don't really care where it's overvalued, but they know that the options in general are overvalued. Then if you wanted to work down into the skew that calls are overvalued, then you'd be selling the call skew. But if it's just in general that it's a flat skew but volatility is elevated, then that's something you would run, you know, not the iron condor, or you'd run the straddle. Reason why people would run the iron condor over the straddle, collateral restrictions. Nothing that, because when you're selling straddles and you're selling strangles, you're essentially selling both underlyings naked. Um, so you're forking over a lot of collateral in that case, and then versus the iron condor, same setup as a straddle, sell a call, sell a put, but then you're buying a call, buying a put. So you're essentially really trading in unison two credit spreads. So like we'll go to Tesla for this one. Right? So if I believe Tesla's fucking range bound, right? And we know that there's going to be a volatility increase at probably some point here, but in terms of the lesson, if we believe that, you know, this is range bound between, let's say, 710 and fucking call it 650. Okay, going to the option chain, you know, take a straddle pricing per normal. You know, what is it for the week? Like we had 662. You know, roughly 30. Let's call it $33 range. Okay, select the iron condor. All right, so we'll just choose the at the money one. All right, so a couple ways you can structure this. When you're playing these around, like if your short legs are around the at the money, you can be playing in some hot water. So when I'm structuring these, especially for my new guys, I like to take my straddle ranges immediately. So what I like to do is, since you're creating your barriers in the underlying, and we'll look at the risk profile on this. So you're going to take your short leg, right? So let's say for the call side, and you're going to go, what was 33? Yeah, so we'd take the 600, right? This won't show much premium because we're only 3 days to expiration, but this would be in terms of if you were playing fucking oh, hand it with the other way. 720. But in terms of playing earnings, you're going to be doing this 2 standard deviations. The predicting alpha guys, they trade a lot of 1 standard deviation iron condors, but those guys are experienced. They're hedge fund managers, so they can outlay the capital to do that. But if you're growing accounts, it's always the best to probably stay just 2 standard deviations out, because God forbid that one move against you ever fucking happens and you take assignment or something. It's just not anything you want to fucking deal with. All right, so the call. All right, so and then we'd go. So you can kind of change. So when you're adding the bot leg now, so since we're 2 standard deviations out for this 720 strike right here, you can choose. You can go another 2 standard deviations out, but I would probably just recommend keeping it rather tight, because you are selling an option. The tighter you bring in that bot call, the less collateral you are going to put up. So people who have relatively larger accounts, like I believe Andrew has a lot of capital in his account, but you know, you could probably go out a little farther to capture more premium in this. Um, I did the 720, so yeah, you could take like the 750, or you could even bring it closer if you just wanted the $5 range. We'll even do that, right? So give it a $10 range. Right? So you could make these the 1 standard deviation away from the put down here, or from your other call. But if you wanted to keep it relatively, you know, wide, like how it is, like this is roughly structured to be a 2 standard deviation move. Tesla would need a 2 standard deviation move to hit the 720 strike, or bang to hit the 660 strike. Oh wait, oh no, I didn't change this down. Shit. I knew the premiums were a little high for a reason. Right. So, all right. So the risk reward isn't going to look pretty on this, but anyway, still two standard deviation structured. $10 wide points on each of the wings. So $10 wide on this wing, $10 wide on this wing. You'd sell the iron condor for roughly, let's say $1. And if Tesla stays in this range, congrats, you made $1 or you made $100. Um, a lot of power going into this again into earnings because the puts and calls become very overvalued. So in terms of you want to be essentially selling the dream at earnings, right? So if the underlying has earnings, you want to be able to find, you know, which are the strikes where the retail traders are buying. I want to find the basically the dumbest retail traders and where implied volatility is going to be high because there are people that are buying up the 700s and higher still in this expiration chain. Okay, they're bidding all that shit up. Look at the open interest and the volume. People are still buying all this shit, still all actively fucking traded. And probability is not with them. Chances are Tesla doesn't. These are all fucking gambles or people who have been holding these already. So we're comfortable being able to sell these options because we know that the probability is on our side to do that. Tesla would need a massive move to be able to reach that. And in the event if you saw Tesla ripping, you just close the position. It's that simple. If it looks like it's getting close to your short strike, or there's a potential it could hit it, and let's say volatility is cooking up, and if the principles aren't there and volatility is coming in, the volume's coming in, then that's the time you want to take off the iron condor. This is not a strategy to try to hold through a move. Strictly, you want to try to capture where you think volatility is going to fade out at some point. So you're selling the dream on either fucking side, and then creating opportunity for you. And you can create even better opportunities, going farther out in time. Like if we're thinking, Tesla may have, a break at some point out of this range. But we think maybe in the next 3 weeks it's probably good, or let's say call it the next month, we're going to be consolidating. All right. So we'll roll all these out. Table. Oh, wow, that was convenient. Um, again, so we'll take, we're 10 points wide. So that's $2,000 in collateral we're already putting up. Okay. Because it's $10 wide here, $10 wide here. But then we'll take the cost for this, and that's $522. So that would be putting up roughly $1,500 in collateral. Because we're always taking distance between the strikes. Okay, again, $10 wide, and then you just subtract it. So like I said, for your $2,000 you're putting this up. Max profit's gonna be $522, and you only really have 24 days for if Tesla can remain in this range, then that's going to be great for you. And if you want to go farther out in terms of if you want to go an extra standard deviation because you're new, you're nervous, whatever, that's something you can do. But again, the risk reward is going to look always a little bit different when you're on the short side. If you were to roll this iron condor, because right now this is a short iron condor. If you were to make this a bot iron condor, all you're doing is flipping the strikes, and it's essentially it's two debit spreads then. Or you could just call it a straddle with short legs on it, either or. But we'll flip these real fast. Yeah. So then it looks like this. It's just essentially a debit spread. Buy the 720, sell the 730. Whatever the cost would be there. Your max profit would be $200. Yes, max profit in this trade would be $1,500 for a $500 outlay. Spot iron condor. Like I said, this be probably not the right way I would set up the bot one. I would probably just go back down to the one standard deviations if you're running a bot iron condor. That way you can move your short leg in a little bit more and be able to capture a little bit of premium, and you'll be able to have better Greek setup on the long options. So it'd be like the fucking 690, and then you could go out and sell that what was it, the 720. This one, bump this one up to the 630 again. You know, yeah, so still 10, roughly 10 points wide. You know, not a little not bad little setup, but just something you can do. More tools for the fucking tool belt. I don't really like to run long iron condors. I find them to be more of a headache to fucking manage. I'd rather just run a debit spread, plain old, instead of just running in and rolling out. I feel like sometimes you can get yourself caught in overpaying for the option. Um, just because iron condors can tend to have a slightly wider spread depending on how your strike selection is. If you're on like an off laid strike, like a those weird strikes, like 572 $2.50. You know what I mean? $572.50. Like those are weird strikes. Generally can cause the bid ask on your spread to be a little fucking skewed wrong. But so just pay attention to that. I try to like if you can get the liquid strikes, stay on the liquid strikes. You know, if you're within five, couple bucks of the implied range on your strike, and it's not perfect, that's fine. Just find the closest one to it. Not a big deal. But in terms for iron condors, um, they're really the bread and butter for most earnings based strategies. And it sounds fucking silly because there's a big misconception in the Instagram world that iron condors are meant for a fucking sideways market. That's not necessarily all the time because they work great for earnings. Like selling overvalued is that's what you do. So much more power than people really fucking think. And it bases off being in a sideways market is how wide you want to be. You could be in these on Tesla, right? Like if you're selling, 6 months out a fucking $1,000 call, and then you're selling a $500 call 6 months out, probably at some point you're going to capture a decent amount of premium on that. We'll even look at it here. 6 months out, was that fucking put us in September? Oh fucker. Um, the fuck was I doing? Yeah, switching this. Okay, but yeah, so like even in terms of like this selling the 700. Oh, actually, let me bump this up to the fucking selling 1,000. This is just an example why I chose the 500, just for like the ranges. Bump this down one more. All right, so let's say you're selling an iron condor. God damn it, dude! I knew this was messed up. Selling the iron condor. Even 6 months out, capturing fucking. Obviously, you could probably play with this a little bit, make better terms of risk reward. Um, Collateral will be a little higher on this trade, but there's still you can run these separate. Just because this is telling you what it is, the premiums are still different between the two. Sometimes it's better to close it out together, but if you think you can maximize it and separate them separately, because you can enter this, sell it for X amount, sell it for $4, put up the 4,000 for collateral, and then if you notice that instead of just managing it as one spread together, if you notice, okay, I'm looking at the put side here, look like it's starting to make a little slightly bullish move up, and I'm able to capture some good premium on the puts, and if you feel like that bullish move for the short put spread on this half down here is done, you can just close these two legs out right together as close a regular credit spread, bang, you're out. And then you just have your call spread to then manage, or your short call spread to then manage. And then if the stock, in the event the stock fucking moves down on the rally, okay, you can capture some premium there too. So you're now capturing the fucking bearish move, and you essentially capture green on both sides, and then closing it in and out as two separate spreads. Although sometimes if the stock pancaked at earnings and it flattened, then you just close it all together like an iron condor. But if it's something that maybe it's moving a little more volatile during the day and you need to kind of manage it a little bit more, then that's the way you're gonna have to. You're gonna have to base it off of what's the trend in the volatility doing during the day. And that's going to be more so the case for an iron condor that's probably shorter term expirations. These longer one moves don't move as aggressively. There's not as much gamma explosion, which really in terms for iron condors, gamma is kind of the worst nightmare for them. Just any explosive moves really not good for the position, but you can always make it work. The butterfly, fucking love the butterfly. Um, oh, and real quick for the iron condor, it's always, let me run over to this. 1 second. I just want to show the risk profile on this one real quick. All right. So this is essentially for this little setup down here. Ignore these two options at the top. Just pay attention to the four green ones down below. But all right, so pay attention. The short, we have short 667, short at 660, right? So pay attention to 660 is gonna be this roughly this little red line right here where the break even is. We got 10 minutes. And then we have roughly another break even, probably around fucking 670, just over that 670, 667 strike. But this is going to be where we capture our premium. This is where this is kind of the barrier. Anything that happens out here, start fucking take a loss. We can start take a loss, start take a loss. But anything that's within our short strikes, this is all profit premium for us. So when we're analyzing risk profile, if we take these short strikes and we start to roll them out, right? We'll roll them out, let's say at 680. Roll the bot leg out to the 720. Yeah, it's gonna look a little messy for a second. So let's see, 40. All right, I think I widened this one a little too much, but that's all right. But yeah, I mean, even in terms of this, it's showing you, capture premium on this side, capture premium over here. Anytime that there's these gaps, like we even roll down a little one to even more time on it. The terms of shit staying within your strikes, it's still going to always be the same principle. You're always trying to have the stock stay within the short legs. You never want your outer legs to be fucking touched. That's going to where you're going to start to run into risk early risk assignment. And that's when be where your max losses start to really kick in. Anytime you start to hit those bot strikes, that's your time to get the fuck out of the trade. If your short strike goes in the money, time to get the fuck out of the trade. You don't want that to happen. Like I said, you just want the stock to stay in between. This is your little barrier, 650 to fucking 650 to 680. Again, that's your premium capture. This is all you want to be occur with. Anytime we step out of that, that's bad for us. We don't want any of that exposure. So that's where anytime this gamma steps up, we don't want that. We just want to stay within the short strike. So you kind of be a little more systematic, capture decent amount of premium. Real quick, just touch on these styles. The butterfly is buy one, sell two, buy one. I know it sounds complicated. It's really not. But in terms of the butterflies are very, very, very good aggressive strategies. I consider these to be advanced aggressive strategies because you can be long and short at the same fucking time, and super powerful to do it that way. A big common strategy right now is most people will buy the at the money or one or two steps in the money call. So we'll just call it the 665 right now, the at the money. And then they'll go 2 standard deviations out. So let's say, or we'll call it whatever, $60. Yeah, so 720. And then you can go another standard deviation out if you won't. Yeah, so in terms of this, it's really more so you're looking to have so this last leg collateral purposes. That's all it is because you're running an extra short leg. You're essentially running half of this spread is very similar to a debit spread because you're buying a leg and then you're selling one slightly above it and then you're selling a leg and then you're buying another one higher. So it's essentially call debit spread mixed call credit spread. Very powerful because if the stock, you have the 665 and, expirations next week, if the stock slowly starts to trickle up to that 700 mark, but let's say there's some volatility fluctuations and it's dip down and back up. That's going to heavily benefit you selling the 720 call, and that's going to pay for your long leg and your other long leg. In the event it starts really moving, you probably want to close the short legs, or close one of the short legs at least, so you have a little bit less risk on the table. But it's really, you're looking to have the stock not hit 720 super fast, so you can capture some of the time decay and the volatility that falls off. Because remember, you technically are 2 standard deviations out, so the probability is in your favor being the seller at this strike. But the inevitable can always fucking happen. So we're selling that for that reasons. And if we're selling the 720, let's go take a look for what the premium cost roughly is. That's $1,200. Call it like $1,300 in premium since you're selling 2 strikes. And then you're buying the 665 down here, and that's already $2,500. So you've essentially already just wiped off a half of that cost. And then you bought the 750, which was fucking dirt cheap. And then, that's only an extra $300. So in terms of calculating like max risk and whatnot, well, it's always going to look a little higher, and they're going to cap your max risk off of basically the amount of premium, or the max risk you can really take. Basically, the premium that you're taking in, whatever the collateral cost is always going to be your max risk, which is usually mitigated on a butterfly. Usually isn't too bad. If you sell something for 50, you might have like $150 fucking collateral cost, but you can have very, very high percent returns because this little gap here, the stock can move quite a bit. And then let's say it's at 700 by expiration. Well, my call is in the money, so intrinsic value is already going to be helping me. And these are out of the money, so this thing's going to already fucking rot. And you don't really care what the hell this option does. If you want to close these two separately and roll out of it, you can close these two as a call spread to try to mitigate any potential loss. If you were rolling out one by one, you can just sell it as a call credit spread, and generally that would be for profit. And then you can roll out as a call debit spread, and you'd be in profit for that. You should be heavily in profit for that. So butterflies, very, very, very good trades. The risk profile does look a little odd, but let me get it real quick. Oh shit, I'm still with fucking iron condors. So I'm trying to burn through this so we don't hit the fucking time allotment. Yeah, so the butterfly, kind of similar to how the iron condor looks. Should be a little sharper. This sharp fucking spike, that's really where you're selling that premium on this fucking 750 area. So that's really where, when I'm telling you, like, you can capture, you want to capture the premium, right? You're trying to have the stock slowly move up. I know this is a little tight down here. It's 640, 650, 660, but your max profit is going to be when you can collect the most premium on these short legs, and then you can kind of manage and mitigate to be able to let the the long legs kind of do their thing. So stays in between, your strike area, and you don't want this to go in the money, so you can kind of capture that the max profit. Same thing for puts. Switches to put side, same fucking structure, same principle. Really not much different. Same thing. Um, selling these is kind of just on the opposite side. I don't really like to sell butterflies all that much. They're really more of a to me, they're more of a way to leverage fucking your percent returns. Can you capture a good amount of volatility doing this? Yeah, but you're tending with short butterflies, you're putting up a lot of risk premium generally. So that are risk collateral, and I really try to not do that for these trades, unless there's for some reason the implied volatility could be through the roof, like a GameStop situation or whatnot. But generally try to stay away from the short butterflies. I think they work way better when you buy them, only for the sense of a small account is looking for a higher percent return, and that generally always happens with butterflies. This is about to end, boys. So I'm just gonna end this real quick so I can get the video fucking processed up. Any questions so far?
No, that's good.
No, I'm
I'm
good.
just gonna have to go through it again.
Yeah, me
But-
too.
Yeah, I know, Reach. I know you missed that fucking first part, but yeah, there's all the shit in there. In terms for callers and synthetic combos and shit, I'm gonna save that for a little bit longer because that's kind of all shit you do with stock, and it's really more so for like financial advisors and like people who are really managing massive fucking portfolios, like 500,000, multiple millions.